Hey investor friends, I'm Michelle Markey, and if you're like me, you're trying to make the most informed decisions when it comes to saving and investing toward retirement, and it can be overwhelming with thousands of stocks and funds to choose from that it's hard to know what is the best and right way to invest. And the answer is not a one-size-fits-all because everybody has different investing goals and needs, but you should pat yourself on the back for being proactive in wanting to know your investing options. And also while you're at it, be sure to like and subscribe to my video and YouTube channel, because I'm going to help you avoid the one mistake that could be costing you millions of dollars over the course of an investing lifetime, and that would be target date funds, or also known as lifecycle funds or age-based funds, and we'll get into why this is such a big deal. And whether you're starting out investing or you've been investing for a while, you might have picked up a target date fund somewhere along the way, because when you first joined an employer, they might have automatically enrolled you in a 401k target date fund that most closely aligned with your target retirement age, which is usually 65 for most people. So if you're a millennial like me, you might have been enrolled in a target date fund for 2055 or 2060, or maybe you've been investing outside of a workplace retirement plan and you might have invested in a Roth IRA or a traditional IRA or an individual account and invested in a life cycle fund just to have another option aside from an S&P 500 index fund or some stocks that you might like. And it's easy to understand the appeal and popularity of target date funds, because all you have to do is add 65 to your birth year and then match that with the next closest target date fund year, and boom, done. Simple. It's so easy to just sign up to a target date fund. And I'll talk about some of the pros and cons that you should keep in mind, such as how target date funds pros include how it's the ultimate autopilot way to invest, and all of the assets that you could imagine wanting are all in one vehicle, so that's simple enough. And then it seems to offer plenty of diversification. And then some of the cons could be that they have higher expense ratios than passive index funds, and you can't change the asset allocations, and they may not be the best hedge against inflation, and past performance is not guarantee of future performance. And also some might argue that it offers way too much diversification that you might not even know what you're even actually invested in. So these are all things to keep in mind if you want to invest in a target date and life cycle fund. And while the first target date funds were created in the early 1990s, most modern target date funds have been around since the mid-2000s, so their investment track record is somewhat limited, but it's generally been positive for a lot of investors over the last 15 years, so you couldn't help but do well if you were in a target date fund across the majority of the last decade and a half. And in general, you can think of target date funds as a funds of funds, as they try to achieve objectives similar to what you would get in mutual funds and index funds. But the difference is that mutual funds got a lot of bad rap, especially when they were actively managed and they produced somewhat mediocre returns with higher expense ratios. And then a lot of times a passive index fund got you better returns with lower expense ratios. So target date funds are somewhere in between, with attributes of both actively managed mutual funds and passive index funds. And so you can see that the asset allocation has a majority usually in equities, more so in US equities or domestic stocks, and less so in international stocks or non-US equities. So there will be a bunch of mutual and index funds that target date funds are often invested in, and to a lesser extent they're in bond funds, and there'll be more in bond funds the older you are and closer to retirement you might be. And you'll also have a little bit of short-term debt or money market funds in the target date fund, but not as much. So for the most part, the target date funds try to have asset allocations across a bunch of diversified mutual and index funds, and also a little bit of bond funds. Different brokerages and workplace retirement plans may have slightly different life cycle funds, but they'll all have comparable compositions because they will have asset weightings that for younger people will favor the riskier equities, and then as we grow older we'll have the more conservative bond funds. So they're all pretty similar, and this is just for information and is not advice. But let's check out what Fidelity prescribes in their Freedom funds, and we can check out with their interactive widget. And as a millennial, let's say I want to retire in 33 years from now, so the target date fund I might select is 2055, and then it shows me me that I'm 90% in equities, and that will be 54% in domestic equity funds, 36% in international equity funds, and then 10% in bond funds. And then as I grow older, by the time I might hit my target date of 2055, then I'll be in 53% stocks and 47% bonds. And then past retirement age in one's late 60s or early 70s, I might then be closer to 21% in stocks and 79% in bonds as I grow older. And then let's say you're below 50. If you're a younger Generation X or an older millennial, you'll still be at 90% stocks and 10% bonds. But then as soon as you hit around 50 and you're in the middle of Gen X, you might be having 79% in stocks and 21% in bonds. And then if you are an older Gen X, like retiring in 2030, you'll probably have target date funds put you at 63% of stocks and 37% of bonds. And if you're a baby boomer retiring in 2025, then you'll be put at 57% stocks and 43% bonds. And then the asset allocations will follow what I mentioned earlier, where you'll increasingly have higher levels of bonds and much less in stocks as you grow older. But with the current interest rate environment, you have to ask yourself if these common investing advice allocations are really appropriate for a lot of people, because bonds are returning very low yields in current low interest rate environments, and with inflation rising, they actually make the value of bonds worth a lot less. So I kind of question whether this is a wise way to have your assets be allocated, and I actually don't think that bonds should be in most people's portfolios. Like, even if you're much older, like in your 60s and 70s, I also don't think that bonds are helping you very much, because like I said, inflation with as high as it is right now is causing the value of those bonds to be a lot less. So they turn out to be a lot less secure of an investment. And not that stocks might be that much better, but they might be slightly better than having a lot of your funds in bond funds. So I would kind of question these asset allocations and look to something else that might be a better fit to your investing needs. And if we evaluate the performance and fees of target date funds versus a passive index fund like the S&P 500, we can see that target date funds generally lag behind a passive index fund. So this means that we're getting below average returns and paying higher expense ratios. So what's the point of having a target date fund? And this is evidenced by if we see the Fidelity Freedom Fund target date of 2055, that in 2021 it only returned 16.5% compared to the S&P 500 returning 28.7%, and that's a difference of more than 12% that the Freedom Fund trailed the S&P 500 by. So that doesn't seem like a good deal. And in addition, the expense ratios are much higher at 0.75% for the Freedom Fund, and that compares to the S&P 500 fund that Fidelity has, where the expense ratio is only 0.015%. So this means if you have $30,000 invested in the target date fund, you're paying $225 compared to if you just had it in the S&P 500 fund and only paying $4.50 over the course of a year. So overall, it's almost no contest between the target date fund compared to a passive index fund based on just performance and fees alone. And this has also been evidenced by research that has been done showing that on the whole, target date and lifecycle funds have trailed the simple S&P 500 fund over 15 years. So overall, that should be plenty of evidence to show that target date funds are not as ideal as if you had just invested in a simple passive index fund like the S&P 500. And the real kicker is how a seemingly small difference in returns of 5% can make you miss out on millions of dollars of gains. And let's use some numbers to demonstrate why. If we look at the Freedom Fund's returns over the lifetime of its existence of 10.2%, this trails in comparison to the S&P 500's returns of 15.2%. And let's say you're contributing $6,000 to your Roth IRA every year, and you put all of it in either an S&P 500 fund compared to a Fidelity Freedom Fund, and see how that progresses after 35 years. And if you just invested in the S&P 500, you would have had $7.25 million compared to investing in the Freedom Fund and getting only $2 million. And that's how you have a difference difference of $5 million plus in where you gain so much more by investing in the low cost index fund compared to investing in the target date fund. So if that wasn't evidence enough, this gives you something to think about and do your own calculations to see how your portfolio might perform. And of course, the past performance is no guarantee of future performance, but it definitely makes you think about the overall lifetime performance of different kinds of funds and how you should be careful in calculating what you think will get you the best returns over time. So the way I see it, if you don't want to settle for below average returns with higher expense ratios, there are two ways that would be good with one of the best investors of all time, Warren Buffett. And he says for most people, the best thing to do is own the S&P 500 index fund. And the second path that you can take is one that's less traveled, but it's the one that I like to do, which is to study individual companies so that I can invest in their stocks. And that's what I like to do. And there's nothing wrong with investing in the S&P 500 index fund, but I'm trying to be above average. And the way that I've learned that how Warren Buffett has achieved above average returns is by investing in individual companies and their stocks. And that's what I'm trying to do. But there's nothing wrong if you want to invest in a passive index fund. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be and avoiding missing out on millions of dollars. Till next time.